$60,000. That's where Bitcoin is sitting right now, and if you've been in this space for any length of time, you know exactly how painful that number feels, because just 10 months ago Bitcoin hit an all-time high of $126,000. $126,000. And this week, it crashed nearly 50% below that peak, dropping to its lowest level since October 2024. So what happened? Was this predictable? And more importantly, what does it mean for your portfolio going forward? I'm going to break it all down for you today. The triggers, the macro forces, the broken narratives, the legislative headwinds, and what analysts are saying about where Bitcoin goes from here. Stick with me, because this story has a lot of moving parts, and every single one of them matters. Let's start by putting this week in proper context, because the numbers are genuinely staggering. Coming into the first week of June 2026, Bitcoin was already under pressure, trading in the high 70s and low 80s after reaching that September peak of $126,000. But this week was different. This week was a full-on collapse. By Tuesday, prices had fallen to their lowest levels since early April. By Wednesday, Bitcoin was breaking below $66,000, a drop of more than 12% on the week alone. By Thursday, it had slid under $63,000, a level not seen since February, and by Friday, Bitcoin cracked through $60,000, touching $59,764 at its lowest point, its worst level since October 2024. To put that in perspective, the flagship cryptocurrency ended the week down approximately 17 to 18% for those 5 trading days alone, and over the past 4 weeks, it's lost more than 21% of its value. That's not a dip. That's a full-blown rout. And here's what made it even more jarring for investors. While Bitcoin was hemorrhaging value, the stock market was doing the exact opposite. The S&P 500 was pushing toward new records, the Nasdaq was climbing, AI stocks were on fire, global equity indices were setting fresh all-time highs. The divergence between crypto and traditional markets was not just noticeable, it was historically unusual, and it directly challenged 2 of the most fundamental stories that Bitcoin bulls have relied on for years. But we'll get to that in a moment. First, let's talk about the spark that lit this fire. Okay, so here's where things get almost absurd. The company at the center of this chaos is Strategy, formerly known as MicroStrategy, the corporate Bitcoin treasury giant co-founded by Michael Saylor. Strategy holds 843,706 Bitcoin on its balance sheet. That's worth north of $60 billion. It is, by a wide margin, the largest corporate holder of Bitcoin on the planet. On June 1st, Strategy filed a Form 8K with the SEC disclosing that between May 26th and May 31st, the company had sold 32 Bitcoin, 32 coins, at an average price of $77,135 per coin, raising $2.5 million net of expenses. For context, that sale represented less than 0.004% of Strategy's total Bitcoin holdings. Less than 0.004%. In financial terms, it's a rounding error. It barely registers as a line item. And yet, the market immediately treated it like a 5-alarm fire. Why? Because this was Strategy's first Bitcoin sale in nearly 4 years, and because Michael Saylor had built his entire persona, his entire brand, on the gospel of never sell your Bitcoin. He made it a mantra. He made it a meme. He made it the cornerstone of institutional credibility in the crypto space. So when that sale was disclosed, even though it was tiny, even though it was to fund preferred stock dividend obligations, it cracked investor confidence in a very specific and very dangerous way. It introduced doubt. It suggested that the never sell era was over. That going forward, Strategy's Bitcoin treasury could become a funding mechanism, a source of supply to the market. And markets hate uncertainty more than almost anything else. The day of the disclosure, Bitcoin dropped 3.1% to about $65,391. Strategy's own stock fell nearly 6% on the news. Within the week, over $160 billion in total crypto market value had been erased, and the cascade of liquidations that followed, hundreds of millions of dollars in leveraged long positions being forcibly closed, amplified the downside pressure dramatically. Crypto exchanges recorded $594 million in long liquidations in a single 24-hour window shortly after the news broke. By Thursday, over $1.5 billion in leveraged crypto positions, mostly bullish bets, had been wiped out in a single day, the largest such liquidation event since February. All of it started with 32 coins. Now here's where it gets systemic, because Strategy's sale wasn't acting alone, it was the trigger that ignited an already smoldering fire of institutional outflows from Bitcoin ETFs. Let's talk about those ETF numbers because they are record-breaking, and not in a good way. US spot Bitcoin ETFs, which launched in January 2024 and became a massive catalyst for institutional adoption, recorded outflows for 13 consecutive trading days starting May 15th. That is the longest outflow streak in the short history of these products. And when you add up the numbers, total outflows across that 13-day period hit $4.4 billion. Yes, billion with a B. The biggest loser? BlackRock's iShares Bitcoin Trust, known as IBIT, widely considered the flagship institutional Bitcoin product. Over those 13 days, IBIT alone saw approximately $3.3 billion withdrawn. That's about 75% of all the outflows. Fidelity's FBTC shed another $456 million. To make matters worse, this selling wasn't limited to the United States. European crypto ETPs recorded roughly $167 billion in outflows during the week of May 25th to 29th alone, showing that institutional de-risking was happening on a global scale. At its peak, year-to-date flows for spot Bitcoin ETFs turned negative for the first time since launch. Let that sink in. A product that had become a symbol of crypto's mainstream arrival was now, net-net, experiencing a capital retreat. So who's doing the selling? Analysts at Presto Research pointed to a key factor: competition from gold and artificial intelligence stocks. As investors scaled back their expectations for Federal Reserve rate cuts, a development that's been building all year, they've been rotating capital into assets seen as more reliable in the current environment. Gold, which is seen as the classic inflation hedge, and AI infrastructure stocks, which are riding a historic build-out wave. Michael Saylor himself acknowledged this on social media, posting that capital markets are funding the AI build-out at a rate of roughly $400 billion over the past 6 months. The combined capital expenditures of just 4 hyperscalers, Microsoft, Amazon, Google and Meta, are projected to exceed $650 billion in 2026, with the majority flowing into AI hardware, servers, and networking infrastructure. That's an enormous amount of speculative capital being pulled toward a different tech narrative. And Bitcoin, for now, is losing that competition. This brings us to what I think is the most intellectually interesting and, frankly, most concerning aspect of this week's sell-off. Because it's not just about price, it's about story. And Bitcoin stories are breaking down. For years, Bitcoin has operated on 2 main narratives, and they've each attracted different types of investors. The first narrative is Bitcoin as digital gold, a store of value, a hedge against geopolitical uncertainty, an asset that benefits when the world is in turmoil. Under this narrative, Bitcoin should rise when tensions escalate, when inflation spikes, when fiat currencies look vulnerable. The second narrative is Bitcoin as a high-beta tech asset, something that moves with the Nasdaq, amplified. Under this narrative, Bitcoin is the most aggressive expression of risk-on sentiment. When tech stocks soar, Bitcoin soars harder. When they fall, Bitcoin falls harder. Here's the problem: both of those narratives are breaking down simultaneously. On the digital gold side, uncertainty around the Iran situation has kept Bitcoin under pressure for months, even as geopolitical risk remained elevated. But rather than flowing into Bitcoin as a safe haven, capital has been flowing into actual gold. Gold has outperformed, Bitcoin has underperformed. The digital gold thesis is taking serious damage. On the high beta tech side, global stocks have risen to new records this week, with the AI trade intensifying and the Philadelphia Semiconductor Index rallying to record highs. But Bitcoin has gone in the opposite direction. The positive correlation between Bitcoin and the Nasdaq, that was near perfect just a month ago, has collapsed. Bitcoin isn't following tech stocks up, it's falling while they rise. And that's a really uncomfortable place for Bitcoin to be in. Because if it's not tracking gold and it's not tracking tech, then what exactly is it tracking? What is the narrative right now? The honest answer is, there isn't one. And that narrative vacuum is creating exactly the kind of uncertainty that drives institutional investors toward the exits. Legislation is the other force moving this market. The Clarity Act, short for the Digital Asset Market Clarity Act, was expected to be a major 2026 catalyst for crypto. If it advances, it could unlock confidence, capital, and cleaner participation from institutions. That's why headlines out of Washington are showing up in Bitcoin's price. Here's the background. The Clarity Act would create a statutory framework for digital assets in the United States. It sorts tokens into 3 regulatory buckets, clarifies which assets are commodities under the CFTC and which are securities under the SEC, and establishes consistent rules for issuance, trading, and custody. In short, it aims to replace uncertainty with clear lanes so firms can operate and investors know the rules. Markets price that clarity in. Citi tied its 2026 base case Bitcoin target of $143,000 to the bill's passage, with an estimated $15 billion in additional net ETF inflows once it clears Congress. JP Morgan called it a potentially significant driver in the back half of 2026, and as recently as early May, prediction markets put passage odds near 80%. That optimism, and any change to it, feeds directly into price. But then the wheels started to come off. The Senate Banking Committee held its markup vote on May 14th. Progress stalled, lawmakers remained divided on key provisions, and now, as of this week, the Clarity Act is drifting further out of reach as legislative priorities shift. The market had priced in a significant probability of passage. As that probability declines, that optimism is being unwound, and it's showing up in the price. Let's talk about two more forces weighing on the market. The specter of Mt. Gox, and the key technical levels traders are watching. Mt. Gox, the infamous exchange that collapsed in 2014, has been distributing Bitcoin to its creditors over the past couple of years. Large wallet transfers associated with Mt. Gox were observed this week, and speculation around additional selling from those coins helped fuel bearish sentiment. Now, to be clear, these transfers don't automatically mean selling. Creditors can choose to hold. But in a week already characterized by fear and forced liquidations, any hint of additional supply hitting the market was enough to push prices lower. On the technical side, traders have been watching two key levels with extreme focus. The first is $60,000. This was viewed as critical short-term support. Bitcoin broke through it briefly on Friday, touching $59,764 before recovering slightly. Whether that break holds or was a brief wick below support will be closely watched in the coming days. Some analysts believe that a decisive, sustained break below $60,000 opens the door to much more significant downside. The second level, $50,000. Multiple analysts have started floating $50,000 as a potential bottom for Bitcoin this year, if the current conditions persist, if ETF outflows continue, if the Clarity Act fails, if AI stocks continue drawing capital away from crypto. BTC at $50K is a level some are starting to talk about as a bottom this year. Paul Howard from liquidity provider Winsent said this week. It's not a consensus view, but the fact that it's being discussed at all tells you something about the current mood. The Crypto Fear and Greed Index printed at 11 on June 3rd, its lowest reading of 2026 and deep into extreme fear territory. Historically, sustained readings below 20 have sometimes preceded local market bottoms, but they've also persisted for extended periods before any recovery materialized. Before we look at the path forward, let me quickly cover the collateral damage across the broader crypto complex, because Bitcoin wasn't the only thing bleeding this week. Strategy, which had become something of a proxy for institutional Bitcoin exposure, was down roughly 11% on Friday alone, and approximately 27% for the week. That would mark its worst weekly performance since November 2022, which was, if you remember, the month that FTX collapsed. So we're talking about Saylor's company having its worst week in the 3.5 years since one of the biggest crypto scandals in history. That's significant. Coinbase, the largest US crypto exchange and another barometer for institutional sentiment, was on pace for a 21% weekly loss, which would be its worst week since February 2023. Ether fell below $1,900, a level it hasn't seen in months, down nearly 8% in a single day at one point. Solana fell 9%. Dogecoin slid more than 8%. The total crypto market cap lost roughly $160 billion in value during the week, and active addresses on Bitcoin hit a 4-month high, which sounds positive, but in this context, it reflects heightened activity driven by fear selling and position management rather than new enthusiasm entering the market. Alright, so we've gone deep into the darkness. Let me give you the other side. First, the ETF outflow streak broke on Thursday. After 13 consecutive days of net outflows, Bitcoin ETFs collectively eked out a net inflow of $3 million on June 5th. That's a tiny number, but streaks have to end somewhere, and the direction of that reversal matters psychologically. Second, history shows that extreme fear readings, like the Fear and Greed Index printing at 11, have often marked or been close to local bottoms. Every major Bitcoin crash in recent history has eventually resolved into recovery. The question is never really if Bitcoin recovers, it always has, but when and from what level. Third, the fundamental case for Bitcoin hasn't changed. The supply is still capped at 21 million coins. The halving cycle is still playing out. Institutional infrastructure, ETFs, custody solutions, corporate treasury adoption is more developed than it's ever been. And legislative clarity, even if delayed, is still more likely to arrive than not. JP Morgan, Citi, and many other major institutions still have bullish long-term price targets. Fourth, Saylor himself has framed the current moment as a temporary reallocation, not a structural breakdown. His argument is that once the $400 billion AI build-out cycle matures and capital expenditure peaks, liquidity will rotate back toward Bitcoin. Whether you find that convincing or not, it's a coherent macro thesis, and Saylor has been right before when conventional wisdom said he was wrong. What does Bitcoin need for a real recovery? A few catalysts stand out. Progress on the Clarity Act would be huge. A pause or reversal in ETF outflows, sustained, not just a single day, would restore confidence. A shift in the Fed's posture, perhaps signaling rate cuts more clearly, would help. And frankly, Bitcoin just needs a break from the news. A period where nothing alarming happens, where sellers exhaust themselves and buyers gradually return. Here's where I land after all of this. This week was genuinely bad for Bitcoin. Not catastrophically bad. It's happened at these price levels before and recovered, but genuinely, meaningfully bad. The combination of the Saylor sale, record ETF outflows, broken narratives, legislative uncertainty, and a stock market that left crypto behind created a perfect storm of negative sentiment. Bitcoin is now 50% below its all-time high. That hurts. There's no way to spin that as anything other than a difficult reality for investors who bought in at higher levels. But context matters. Bitcoin has been written off before, many, many times, and every single time, it has come back. The question for you as an investor is whether you have the conviction and the time horizon to weather the volatility. Not financial advice. Everyone's situation is different, but historically, those who panicked at moments exactly like this one rarely looked back on that decision fondly. Watch the $60,000 level closely in the coming days. Watch ETF flows. Watch the Clarity Act. Watch how strategy behaves at its Monday update. These are the signals that will tell you whether this week's bottom holds or whether there's more pain ahead. I'll be covering all of it right here. If you found this breakdown valuable, please hit subscribe and turn on notifications. This is exactly the kind of moment where staying informed makes all the difference. Thanks for watching. I'll see you in the next one.